Hi, it's Devin from Retirement Wellness SA. And in this video, we're going to be having a look at the different types of death benefits that are available to you when you are picking out your life cover. Now, it might seem pretty weird that there are different types of death benefits. I'm going to walk you through 3 different styles or options that you have for choosing a death benefit. Now, if you've not already watched the initial video of the series in which I speak about the need, then I encourage you to start there because you have to have an understanding as to how much of cover you need for a particular benefit in order to be able to know how the benefit's going to add value to you. So let's head over to the iPad, and I'm going to guide you through the 3 different options that are available for you in terms of death benefit. So your first is your standard. It's what you already know about. It's straightforward. If you had to pass away, this is an amount of money that's getting paid out. It's usually paid out as a lump sum, but there are some options in which the insurance company can pay this out to you or to your family as a monthly income. That's your death benefit. The second is what's called accidental death. Accidental death. Now, this is a benefit that pays out if you pass away, but only as a result of an accident. Yeah, only as a result of an accident, meaning assume that you had passed away because of cancer. It's not really an accident. So as a result, there's not really going to be any payment from your accidental death benefit. So you want to be mindful of that, and we'll compare the 2 just now. And then the last one is a funeral benefit. And a funeral benefit, we'll start to have a look at the differences in terms of the options. But as you know, it's just an amount of money that is sufficient to cover what the funeral costs come to. So these are your 3 options that are available. Now let's start to have a deep dive into each of them and see which one's going to be more appropriate, or if perhaps you're needing all of them. So we're starting off with just your normal death benefit, and let's write in the others here as well. So we've got accidental death here, and we've got your funeral up on this end. Now, from your death benefit perspective, in terms of the amount of cover, usually it's only limited by your income, by your salary, meaning that's how they would determine that amount of cover. So it's limited by income here. And the same would happen with the accidental death, because you can take an inflated amount of cover. Funeral benefits, on the other hand, this generally has a ceiling. You can have multiple funeral benefits, but usually that's ranging. You could start perhaps at 5,000 all the way up to some affluent plans cover you for 100,000, which is quite a significant amount of funeral cover. But you're not going to have a funeral benefit for R1 million. And this is a key point, because if you're needing to have a property, for example, and you want to ensure the property is settled if you passed away, now you know you can't take a funeral benefit for R1 million, meaning you're going to work with a normal death benefit. Now that brings me to the next point of discussion here, which is in terms of, I'm going to call it cession. So if you had to cede this to a bank, now what exactly is a cession? Let's assume that you have a property and you now that you want to purchase, and the finance on this, the bond is R1 million. The bank has a bit of concern with regards to how you would settle that R1 million if you happen to pass away. So the bank then calls for a policy, and that policy, when we say it's ceded, it means you are giving away the right of first claim to the insurance company. Let's use an example for how this would work. Let's assume that your life cover sits at R1 million, and up on this end you've got a bond here, and initially your bond started with R1 million, but over time, because you've been paying, let's say the bond is 800,000. That's what you owe to the bank. And up on this end, we've got your beneficiary here. What would take place when there's a cession is, before the insurance company pays directly to the beneficiary, they would first make this payment through to whoever the policy has been ceded to. So first to the bank, and the bank will take their amount. So they'll take what is owed to them, in this case 800,000. and then the balance of that gets released to the beneficiary. So what you'd find is there would be a split between the two. The bank, though, remember, gets the first draw. It has the first option. That's what seeding means. You're giving away that right first to that provider. In this case, our example, we're using the bank. Now, the bank is not going to allow you to take funeral cover, so that would be a no. The bank's also not going to allow you to take accidental death, because what happens if you passed away naturally? How does the bank make sure that they're able to get their money? Because accidental only pays from an accident. So if you're taking cover for the purpose of covering a bond, it then means you need to have a normal death benefit, a traditional death benefit, and it needs to be equal to that amount of cover that's provided by the bank. Now, next up, let's start to have a look at your need. I covered this in depth in the first video, but you almost want to sort of analyze how much of cover is required. In terms of your death benefit, how much is required if you happen to have an accident, and how much is required for funeral. Chances are for this one, on the funeral side, you can decide, right? So you can decide pretty easy on how much you want. Same in terms of your accidental death benefit, because you can put those figures together. But here, you actually want to have this calculated, because you want that to be a lot more accurate. And I shared the secret inside the first video of the series, how you can go about taking the life cover policy so it's more meaningful. Remember, if you're taking the policy based on what you need from the policy, then you're going to pay for something that's actually of value for you, because you're paying for what you need. But if the life cover policy is going to be sold to you based on fear that if you passed away, how would your family survive? Then you could fall into the trap of paying for a lot more cover than what you actually need. Which brings me to the next point that I want to share with you, and that is something that's very easily forgotten about. It's what's called group life cover. Now, perhaps you're working for a company, and that company has a pension fund or a provident fund, and attached to that pension fund or provident fund is a life cover. And that is what we refer to as group life cover. Now, group life cover is usually provided without any medicals, and it's provided as part of the company offering. In most cases, the company is actually financing a particular benefit, which means if you think about it, group life cover offers you free cover. It offers you free cover. Now you want to be very mindful about how you tackle this, because again, coming back from the need perspective, if your need is, let's use an example actually, so that I can make this better for you. Let's just assume from a need perspective, you need to have 5 million Rand life cover in total. If you use that formula I showed you on the first video to calculate it, right? So you know this is what your need is. And then you know that in terms of the group life, there's already some cover in place. Usually this works as a multiple of your salary. So it could be 3 times your annual salary or 4 times your annual salary. In our example, let's assume that it's 4 times your annual salary, and we'll say your annual salary is 250,000. Again, we're just using an example. So 250,000 times 4, that gives us R1 million. Now, if you look at what's transpiring here, you have a need for 5 million Rand cover, but you already have R1 million in place, which means you just need to cover the amount that is short. And in this case, your shortfall is the 5 million minus the 1 million, and that's 4 million. So when you are taking out your life cover, now you know that you're not going to be insuring yourself for 5 million. And this is something that most people are not taking into account. They're not factoring that there's a group life cover. And they're not minusing that. They're just taking the full amount. So what you want to do is be mindful. This is what your need is. You have to understand the need, deduct the group life cover. The balance of that is what you then want to finance. Now, I know exactly what you're thinking, and that is what happens if you leave the company. Now, if you are leaving the company, then you go back and you reassess your need. And why I want you to do that as a sort of like a reactive way, because if you're going to anticipate that you're leaving the company and you end up staying with that company for 20 years, that means for 20 years, you could be paying more for something that you don't need. See? So you always want to start to analyze. If you know that you want to leave the company, chances are you may move to a new company that's offering even better benefits, in which case your group life cover could be a lot more and your need for normal life cover could be less, and therefore you can go and adjust. So these little techniques are what's going to help you to save on that monthly premium that you have. And then the last secret that I want to share with you is in terms of how do you structure your policy. And you can structure it one of two ways. You can structure it according to a term, or you can structure it to what's called whole life. So when you're structuring the death benefit, you could say you want it for a specified period. For example, 20 years. Typically, this kind of structure happens when you have a bond in place. So then you know that the term of the bond in our example is 20 years, which means you don't really need to have cover for anything beyond that. If you want to structure it the other way, whole life means you have a starting point, but it only ends when you pass away. So it only ends on death. What's different between the two? In this case, in order for you to benefit from it, you're going to have to pass away inside of 20 years. If you pass away outside of 20 years, you no longer have that cover if you didn't choose to extend it, that is, which means the insurance company doesn't make a payment. In this case, because death has to happen, you are assured of getting this payment because you're paying for as long as you live. Why would you take a term cover? Well, from a premium perspective and from a need perspective. If you know you're only settling your bond in 20 years, then there your need is 20 years. And the premium is a lot lower when you're using term because there's a specified period that you want the cover, as opposed to running this for as long as you live. So you can navigate between the two. So now you've got a few secrets from this video. You know the secret between term and whole life. You also had a recap in terms of what your need is, but now you know you can analyze that against your group life cover. And you know the three different styles of death benefits. You have a death benefit, you've got accidental death, and you've got a funeral benefit. And you sort of understand how the three operates. So what I want to hear from you, and you can post that comment below, what benefits do you have in your current life cover policy? You don't have to specify amounts. And then if you are taking a new policy, what benefits are you going to be taking and why? So post in the comments below. And also, if you found the video helpful, remember to click the thumbs up and to subscribe so that you're able to get the next videos as we plug them into the series.